Something extraordinary is happening in the precious metals market right now. Something that defies 4 decades of conventional wisdom. Something that Wall Street analysts are scrambling to explain, and that most retail investors have completely missed. While the financial press has spent 2025 breathlessly covering Bitcoin's volatility, artificial intelligence stocks, and the latest Federal Reserve announcements, silver has been quietly staging the most dramatic rally in modern history. Not a modest uptick, not a temporary spike. We're talking about a full-blown explosion that has more than doubled the price of the white metal in less than 12 months. On December 12, 2025, silver touched $64.65 per ounce. That is an all-time high. Higher than the legendary spike of January 1980 when the Hunt brothers cornered the market. Higher than the 2011 peak that caught everyone by surprise. The record that had stood for 45 years wasn't just broken, it was shattered. And here's the part that should make you stop whatever you're doing and pay attention. While gold has certainly had an impressive year, climbing roughly 60%, silver has absolutely demolished that performance. The so-called poor man's gold has gained over 100% since January. In a world where beating the market by a few percentage points is considered exceptional, silver has delivered returns that belong in a different category entirely. Yet somehow, the mainstream investment community remains largely asleep at the wheel. The nightly news isn't leading with silver stories. Your financial advisor probably hasn't mentioned it. The cocktail party conversation still centers on tech stocks and cryptocurrency. This disconnect between what is actually happening in the market and what most people believe is happening represents one of the greatest information asymmetries of our time. The question isn't whether silver is rallying. The numbers speak for themselves. The real question is why this is happening, how long it can continue, and what it means for the global economy that almost no one seems prepared for what comes next. To understand why silver is outperforming gold, you first have to understand why it historically underperforms. For most of modern history, gold has been the star of the precious metal show. It sits in central bank vaults. It appears in national reserves. It carries an almost mystical weight in the collective financial consciousness. When people think about wealth preservation, about hedging against uncertainty, about the ultimate store of value, they think about gold. Silver has always been the afterthought, the backup option, the metal you consider when gold seems too expensive. This perception has been reinforced by decades of price action where silver moved in gold's shadow, typically with more volatility and less reliability. But that narrative is breaking down in real time. The gold to silver ratio is one of the oldest metrics in monetary history. It measures how many ounces of silver it takes to buy 1 ounce of gold. Go back through the centuries, and you'll find the ratio hovering somewhere between 15 to 1 and 20 to 1. The Earth produces silver and gold at approximately a 7 to 1 ratio from mining operations. Logic would suggest the price ratio should reflect something closer to geological reality. It doesn't. For most of the past decade, the ratio has hovered in the 70s and 80s. In March 2020, during the pandemic panic, it briefly spiked to 125 to 1. That represented the most extreme undervaluation of silver relative to gold in recorded history. It was as if the market had completely forgotten that silver existed as anything other than an industrial curiosity. The long-term historical average sits somewhere between 50 and 67 to 1, depending on which period you measure. Even after silver's massive 2025 rally, the ratio still hovers around 80 to 1. This tells us something crucial. Despite doubling in price, silver may still be undervalued relative to gold from a historical perspective. The catch-up trade isn't over. It may have only just begun. Central banks have become one of the most important forces in the gold market. Since 2022, they have been accumulating gold at a pace not seen in living memory. Over 1,000 metric tons purchased in 2022, another 1,000 plus tons in 2023, and again in 2024, marking the 3rd consecutive year of 4-digit accumulation. From 2022 to 2024, central banks collectively purchased over 3,200 tons of gold, more than doubling the rate from the prior decade. Poland, China, India, Turkey, Kazakhstan, Singapore. The list of buyers reads like a roster of countries hedging against uncertainty in the dollar-dominated financial system. The sanctions on Russia following the Ukraine invasion sent a message that resonated far beyond Moscow. Your dollar-denominated assets can be frozen with a keystroke. Your gold cannot. This massive institutional bid has helped propel gold to record highs north of $4,000 per ounce. The financial press has covered this development extensively, but here's what they're missing. Central banks don't buy silver. Not a single central bank maintains significant silver reserves. Not one. This isn't because silver lacks value. It's because the quantities required would be impractical, given silver as lower price per ounce and the logistical challenges of storage. But this institutional absence creates an interesting dynamic in the silver market. Gold's price is increasingly influenced by the buying decisions of sovereign wealth funds and central bank reserve managers. These are price-insensitive buyers, operating with nearly unlimited balance sheets. When the People's Bank of China decides to add to reserves, they don't check the price first. They simply buy. Silver lacks this official sector bid. Its price is determined by a different set of forces: industrial demand, retail investment, the solar panel factory in Guangzhou, the investor in Mumbai buying coins, the hedge fund in Connecticut taking a position. This makes silver more volatile, certainly. But it also means that when the fundamentals turn bullish, there's no ceiling imposed by institutional buying programs that might temper their accumulation if prices rise too fast. The central bank gold buying has created a floor under gold prices. But it has also potentially created a performance gap that silver is now rapidly closing. If you want to understand why silver is really rallying, you need to look beyond the trading floors and into the factories. Silver is not just a precious metal, it's a critical industrial input. And the global economy has never consumed more of it than it does right now. In 2024, industrial silver demand reached a record 680.5 million ounces. That's up 11% from the previous year. For 2025, projections show industrial fabrication exceeding 700 million ounces for the first time in history. This isn't a temporary spike. This is structural demand growth driven by technologies that didn't exist at scale a decade ago. The solar industry alone has become a silver-devouring machine. Every photovoltaic cell requires silver. The metal's unmatched electrical conductivity and thermal efficiency make it essential for capturing and transporting electrons generated by sunlight. In 2015, solar applications accounted for 5.6% of total silver demand. By 2024, that figure had climbed to 17% and is still rising. The numbers are staggering. Solar sector silver demand reached 232 million ounces in 2024 and is projected to hit 261 million ounces in 2025. That represents roughly a 20% year-over-year increase, driven by massive solar installation growth in China, India, and across emerging markets. China increased its solar capacity by 45% in 2024 alone. Then there's the automotive sector. A traditional internal combustion engine vehicle contains between 15 and 28 grams of silver, used in everything from window switches to seat motors to electronic control units. But the transition to electric vehicles is accelerating silver consumption per vehicle dramatically. A hybrid vehicle uses 18 to 34 grams. A battery electric vehicle uses 25 to 50 grams or more. The wiring, the inverters, the battery management systems, the high voltage cables, the charging infrastructure, all of it requires silver's superior conductivity. As the global auto industry electrifies, silver demand is rising in lockstep. And now there's artificial intelligence. Every data center powering AI applications requires massive amounts of computing hardware. Every server rack, every semiconductor chip, every high-performance connection. Silver appears throughout these systems, serving functions that no other element can match at comparable efficiency. The AI boom isn't just driving demand for NVIDIA graphics cards, it's driving demand for the raw materials that make those cards possible. This industrial demand isn't price-sensitive in the traditional sense. When a solar panel manufacturer needs silver paste to keep their production line running, they don't stop buying because the price went up 30%. They pass the cost along and keep purchasing. When Tesla needs silver for battery connections, they don't cancel orders. They adjust their bill of materials and continue building cars. This inelastic demand creates a fundamentally different market dynamic than what existed even a decade ago. Silver has transformed from a speculative precious metal into a strategic industrial input, and that transformation is just beginning. Here's where the mathematics become truly alarming. Global silver mine production sits at approximately 820 to 840 million ounces per year. That number has barely budged in a decade. In fact, mine supply has actually declined by about 7% since 2016, even as prices have risen substantially. Total annual demand now exceeds 1.2 billion ounces. Do the math, and you get a shortfall of roughly 400 million ounces per year that has to come from somewhere. The silver market has been in structural deficit since 2021. This marks the 7th consecutive year where demand exceeds new supply. The cumulative shortfall over this period totals nearly 800 million ounces. That silver has come from existing above-ground stockpiles, from ETF liquidations during the early years, from recycling, from wherever the market could find it. But those sources are depleting. For 2025, the projected market deficit stands at approximately 117 to 149 million ounces. Some analysts put the number even higher, above 200 million ounces. The exact figure matters less than the direction. Every year the deficit persists, the available inventory shrinks. The Silver Institute has warned of potential structural deficits continuing through 2026 and beyond. A recent scientific analysis examining silver demand through 2030 reached a sobering conclusion. Supply may meet only 62 to 70% of projected demand by the end of the decade. The solar industry alone could consume 29 to 41% of global supply. Why can't mining production simply expand to meet rising demand? Because silver doesn't work like other commodities. Roughly 70 to 75% of silver production comes as a byproduct of mining for other metals: copper, lead, zinc, gold. Only about 28% of silver comes from primary silver mines. This means silver supply doesn't respond directly to silver prices. If copper prices are weak, copper miners produce less, and silver supply falls as a side effect, regardless of what silver prices are doing. Opening a new mine takes 10 to 15 years from discovery to production. If a major new silver deposit were discovered tomorrow, the first ounce wouldn't reach the market until well into the 2030s. Meanwhile, ore grades at existing mines continue declining. Where a mine might have averaged 15 ounces per ton in 2005, today 4 ounces per ton is considered good. Miners have to move 4 times as much rock to produce the same amount of silver. The geological wall is real, and no amount of financial engineering can print silver out of thin air. Something shifted in 2025 that crystallized silver's strategic importance in the eyes of policymakers. The United States Geological Survey added silver to its official list of critical minerals. This designation places silver alongside rare earth elements, lithium, cobalt, and other materials deemed essential to national security and economic competitiveness. It's an acknowledgement that silver is no longer just a monetary metal or an industrial commodity. It's a strategic resource. This designation has implications that extend far beyond symbolism. Critical mineral status opens pathways for government funding of domestic mining projects. It prioritizes silver in defense procurement decisions. It signals to allies and adversaries alike that the United States views its silver supply chain as a matter of national interest. The timing isn't coincidental. As trade tensions escalate and supply chain security becomes a priority, securing access to essential materials has moved from an economic issue to a geopolitical one. The United States imports approximately 2/3 of its silver from foreign sources, primarily Mexico and Peru. Both countries have seen increasing mining restrictions, labor unrest, and political movements questioning the benefits of resource extraction by foreign companies. Mexico produces roughly 25% of the world's silver. The Mexican government has already signaled resistance to new open-pit mining permits. Peru faces recurring strikes and protests that periodically shut down major operations. Russia, once a significant producer, is effectively sanctioned out of Western markets. This geographic concentration of supply creates vulnerability. And vulnerability, in a world of competing great powers and fracturing trade relationships, gets addressed through stockpiling and strategic planning. The U.S. government designation of silver as critical should be understood as a warning shot. The rules of the silver market are changing. What was once purely a function of industrial demand and investment flows may increasingly incorporate national security considerations that could distort prices in unpredictable ways. While retail investors in the United States have been surprisingly passive during silver's rally, the same cannot be said for Asia. India, the world's largest importer of silver, has been on a buying spree of historic proportions. Indian buyers purchased record levels of both physical silver and silver-backed ETFs during the first half of 2025. This demand is not driven by speculation. It's cultural and deeply rooted. Silver has been integral to Indian commerce, jewelry, and religious ceremonies for millennia. Indian retail silver investment rose 7% year over year through the first 6 months of 2025. Physical demand remains strong as consumers view current prices, despite the rally, as still reasonable compared to gold's prohibitive cost per ounce. In India, silver isn't seen as gold's poor cousin. It's seen as accessible wealth. Exchange-traded products have become another massive source of demand. Silver ETPs saw inflows exceeding 95 million ounces in just the first half of 2025, surpassing the total for all of 2024. By mid-year, global silver ETP holdings reached 1.13 billion ounces, approaching the all-time high set in February 2021. Here's why this matters. Every ounce held by an ETF is an ounce removed from the available supply. Unlike a futures contract that can be settled in cash, physically backed ETFs must actually acquire and store metal. As inflows accelerate, they directly compete with industrial users for the same finite supply. The value of silver ETP holdings exceeded $40 billion for the first time in June 2025. That's no longer a niche market, that's institutional scale, and institutional capital is only beginning to reposition toward precious metals. Institutional investors on the CME futures market showed their hand clearly. As of June 2025, net managed money long positions were up 163% from year-end 2024 levels. The average net longs for the first half of 2025 reached their highest level since the first half of 2021. Professional money is betting on continued silver strength. The contrast with U.S. retail behavior is stark. American investors have actually been net sellers into this rally, booking profits after years of waiting for higher prices. U.S. retail demand for silver fell by at least 30% in the first half of 2025. This is the mirror image of smart money positioning. And when retail sells and institutions buy, history suggests the move has further to run. To understand silver's potential, you have to understand how it behaves differently from gold during precious metals bull markets. The data is unambiguous. When both metals rise together, silver tends to rise faster and further. Analysis of historical bull markets shows that silver's rally has averaged roughly twice the magnitude of gold's gains. This isn't a fluke, it's a function of market structure. Silver's market is significantly smaller than gold's, less liquid, more volatile. When investment capital flows into precious metals, the same amount of buying pressure creates larger price moves in silver than in gold. This is leverage without borrowing. Exposure to the precious metals bull thesis with amplified returns. In the 1970s, bull market that culminated in January 1980, gold rose approximately 650% from its lows. Silver rose over 1,000%. The gold to silver ratio compressed from over 40 to 1 down to 15 to 1. In the 2000s bull market, gold broke above $300 in late 2002, eventually reaching nearly $1,900 in 2011. Silver went from around $4 to almost $50, a gain exceeding 800% that substantially outpaced gold's returns. We are now potentially in the third major precious metals bull market of the past half century. Gold has already signaled the direction, breaking through $4,000 for the first time ever. If historical patterns hold, silver's outperformance is not an anomaly to be corrected. It's the expected behavior in this phase of the cycle. The key insight is timing. Silver typically lags gold early in a bull market. The senior metal breaks out first, establishes new highs, and captures headlines. Then silver catches up, often violently, compressing the ratio as traders pile into what suddenly looks like the better bargain. We appear to be in that catch-up phase right now. And if history is any guide, there's substantial room left to run before the ratio normalizes toward long-term averages. Where does silver go from here? Wall Street is racing to update targets that seemed aggressive just months ago. Bank of America raised its 12-month silver target to $65 per ounce after real yields narrowed and ETF inflows strengthened. But some analysts believe that target will prove conservative. BNP Paribas has suggested silver could climb as high as $100 per ounce by the end of 2026. Their thesis rests on the combination of undervaluation, persistent deficits, and what they describe as a new industrial revolution for the metal. When structural shortage meets transformative demand, price discovery enters uncharted territory. Clem Chambers of a new FN called Silver, the fast horse of precious metals and projects, $100 by 2026. Frank Holmes of U.S. Global Investors shares that outlook, citing silver's transformative role in renewable energy as the primary catalyst. Peter Krauth of Silver Stock Investor has been tracking silver for decades. His view is that $50 is now the floor, not the ceiling. He projects silver in the $70 range for 2026 as a conservative estimate, noting that the fundamentals only continue strengthening. Citigroup predicts silver will outperform gold through 2026, potentially reaching upward of $70, especially if industrial demand fundamentals remain intact. But there are dissenting voices. Some analysts warn that silver's rapid gains resemble a blow-off top, that valuations look stretched relative to gold, and that any disappointment on the industrial demand front could trigger a sharp correction. Silver's famous volatility works both ways. The same market structure that amplifies rallies can amplify sell-offs. The prudent interpretation is that the primary trend appears higher, supported by fundamental factors that won't reverse quickly, but the path will not be smooth. 20% corrections within a larger bull market are normal, even healthy. The game is not to time every wiggle. It's to understand the larger forces at work and position accordingly. Why are so few people prepared for this? Part of the answer lies in recency bias. For most of the past decade, precious metals underperformed financial assets. Gold and silver went sideways while the S&P 500 tripled. Anyone who allocated to metals during that period experienced opportunity cost. The lesson learned, consciously or not, was that precious metals don't work in a rising stock market. But conditions change. The debt dynamics that enabled endless asset price inflation are reaching limits. The U.S. government runs a $2 trillion deficit with no recession in sight. Total national debt approaches levels that historically precede currency crises or restructuring. The traditional safe haven of bonds has been compromised by inflation that eroded real purchasing power even as nominal yields rose. Another factor is the gold fixation of the mainstream financial press. When precious metals get attention, gold dominates the coverage. Central bank buying makes headlines. Record gold prices make headlines. Silver barely gets a mention, even when its percentage gains dwarf gold's performance. There's also an element of institutional blind spots. Compliance officers at many financial institutions still classify gold and silver as unregulated or alternative investments, requiring extra scrutiny and disclosures. This creates friction that discourages allocation even when the investment case is compelling. The result is a market where public interest is only beginning, despite prices breaking into new high ground. Retail participation typically lags institutional positioning by 6 to 12 months. The classic wall of worry phase, where prices climb despite widespread skepticism, appears to be transitioning toward broader acceptance. But that transition is incomplete. This information asymmetry creates opportunity for those paying attention. The time to position for a move is before the consensus recognizes it, not after everyone crowds through the same door. Silver, in December 2025, represents something rare in financial markets, a story where the fundamentals, the technicals, and the macro backdrop all point in the same direction. The fundamentals show a market in persistent structural deficit, with demand growing from industrial applications that are essential to the energy transition, electric vehicles, and next-generation technology. Supply cannot respond quickly due to geological constraints and the byproduct nature of most silver production. The technicals show a breakout to new all-time highs, with momentum indicators suggesting the move has room to continue. The gold to silver ratio, despite already compressing, remains elevated relative to historical averages, implying further catch-up potential. The macro backdrop shows central banks accumulating gold at record rates, signaling a loss of confidence in fiat currencies and dollar-denominated assets. Geopolitical tensions are rising. Trade relationships are fragmenting. The conditions that historically favor hard assets are present and intensifying, and yet mainstream awareness remains limited. Your neighbor probably can't tell you what silver is trading at. Your coworker probably doesn't know it hit an all-time high last week. The magazine covers haven't declared a silver mania. The taxi driver isn't giving you hot tips on mining stocks. This is what the early stages of a secular bull market look like. The smart money positions. The price rises on fundamentals. The public ignores it until the move is obvious. Then the late arrivals pile in and drive the final vertical phase. We may be years away from that final phase, or it could arrive sooner than anyone expects. Markets have a way of accelerating when supply cannot meet demand and when financial capital suddenly discovers a new destination. Silver has been called many things throughout history. Poor man's gold, the devil's metal, industrial input, monetary relic. In 2025, it might be more accurately described as the most underappreciated asset in the global financial system. A critical mineral for the technologies reshaping civilization, a hedge against the monetary excess of governments, an inflation-resistant store of value in a world where currency debasement has become policy. The rally that almost no one saw coming isn't over. The conditions that produced it haven't reversed, and the mainstream hasn't yet woken up to what's happening right under their noses. Pay attention, study the numbers, understand the forces at work. Because when the rest of the world finally catches on to what silver has become, the easy money will already be made. If this breakdown helped you understand the silver story before the headlines catch up, hit like and subscribe for more analysis of the forces reshaping global markets. The next phase of this story is still being written,